Hey everyone, how's everyone doing today? I don't think we need music at the beginning of
Good,
this one.
man.
Good to hear it. Hello, fellow retail investors. My name is Marcel Kalinovic, the Butcher of Wall Street. And today we're going to do a deep dive into Credit Suisse, UBS, toxic derivatives, bank bailouts, bonds, stocks, and meme stocks. Because believe it or not, meme stocks are just getting started. So let's get moving right now. To put it quite simply, Credit Suisse's toxic derivatives and bad bets are legacy problems. They're going to bite them in the ass. Move this microphone. And it's a good thing that UBS has secured a $9 billion government bailout. You heard that, ladies and gentlemen. UBS was unwilling to take over Credit Suisse due to legacy problems and required the government to backstop them with a $9 billion bailout. It has not yet been issued, but it will be when they close out a lot of toxic Credit Suisse positions. The stock market is not looking as safe as a lot of people think. I hear a lot of bulls out there calling for a bull run, and that is way too premature. Yesterday, I had quite a few puts on Credit Suisse left over from Friday, and let's say that they went from $2 down 53% to 94 cents. Credit Suisse was previously in October of 2022 saying sell AMC and predicted that stock to head to 95 cents. That has not occurred, although it has had its issues due to a ridiculous amount of manipulation and shorting, proven by a 24.5% short interest and a 250 to 300% average cost to borrow currently. Credit Suisse, however, is the one that has gone under 91 cents yesterday. It was 91 cents in the after hours. The last time we saw the stock market crash, the European Central Bank was already cutting rates. And right now they're still hiking at 50 basis points. Do you have any idea how hard this market is going to crash when this correction actually takes place? Because I don't think the majority of people can even comprehend what is about to happen. And I truly mean that. The majority of people cannot understand the complexities of and how intertwined these derivatives and swaps and banks truly are. It's a really big problem. What we were seeing here was rate cuts already occurring before we saw the bottom. And we almost always see rate cuts and pivots before the bottom of a stock market crash. That's when things truly accelerate. We haven't even gotten there yet. Taking a look at demand for oil. You want to talk recession? Here, let's talk recession. Because it's time. The Fed finally broke something. Let's put it that way. They have finally broken things. Markets are completely unsettled after the fallout from Silicon Valley Bank. And to think otherwise is a joke. Watching a small stock market pump for a day or two really means absolutely nothing. Markets go up and down, period. So, taking a look here, you can see oil demand has been reduced for 2023 and 24 estimates between U.S. and Europe. They incorporate softer realized oil demand, reduced U.S. GDP growth forecasts due to tighter small bank lending standards, and refined OECD demand model estimates. So you see the cumulative change in OECD oil demand since 2019 Q4, downtrending. And the last time we saw greatly reduced demand was in 2020 during a global shutdown. But you can see the chart clearly indicating lower lows and lower highs time and time again. Check out this oil gauge pointing to a weaker market. And Brent crude, this is a time spread. It's a measure of how well supplied the market is. Declined by the most since January, this past Friday, flipping into a bearish structure that indicates oversupply. Biden has been draining United States reserves. So how could we possibly have oversupply unless demand is being destroyed? It's quite simply recession. That's it. There is a massive tightening of conditions going on here. And check out the lagged effects of federal hikes. When you combine that with the tighter credit conditions that we're currently seeing and liquidity issues, it creates a sharp downturn in the economy. They were expecting a soft landing in 2022. We have seen absolutely no signs of a soft landing whatsoever. They are just lagging effects. Everything is just lagging behind, and the tighter credit conditions and lack of liquidity and the fact that the Jerome Powell and the Treasury already had to print trillions of dollars, trillions with a T, in order to save the FDIC, it's just a small indication of how bad this is going to be. Regional banks are being impacted by these funding costs that are increasing, the deposit risks, regulatory pressures, asset declines, and future credit losses from the lagged effects of federal rate hikes. And these combined are likely to trigger a financial collapse. Green means money printing. Red means liquidity is tightening. This is the Bloomberg United States Financial Conditions Index. It went from loose to tight ever since March of 2020. And it gives the Fed an excuse to pause, but I don't think that they're going to pause. They absolutely cannot pause right now, or hyperinflation will continue onwards. And you can see here, major banks are absolutely taking over commercial and industrial lending right now. The majority of banks with less than $250 billion in assets account for about half of all commercial and industrial lending. So they're the ones, banks with less than $250 billion in these assets account for about 50% of the commercial and industrial lending, 60% of residential, and 80% of commercial real estate, 45% of consumer lending. Right now, you're seeing a massive amount of credit card debt, an all-time high of credit card debt in the United States and around the world. And the fact is that when people fail to pay their credit cards, the banks are going to come after them. And a lot of people will likely have to file bankruptcy and will lose their investment properties, if not their main home. Take a look at Q1 GDP. What a joke. These were the official advanced estimates here, way up here in the 6%. And here's the advanced Q1 GDP tracking estimate, right around 2%. They boosted the first quarter GDP tracking estimate to around 2.5% quarter over quarter. And the Fed uncertainty, the 1 year over 1 year volatility, represents uncertainty on the Fed policy, which greatly exceeds the '08 levels. And it did so fairly quickly. You can see here it was a nice climb, kind of more of a steady climb. And here we have a sharp increase, followed by a sharp decrease and an even sharper increase in the uncertainty, and the 1 year volatility reached 203 basis points this week, reflecting the Fed policy trajectory is out of control and is likely to continue increasing. I'm looking at a 25 basis point hike coming this Wednesday, and another 25 basis point the next time the Fed meets as well. Those are just my estimates. I'm not a financial advisor, and nothing you hear is financial advice. Do your own due diligence. These are global bonds, and take a look at this. The value of all bonds has increased an astronomical $2.1 trillion since 10 days ago. 10 days ago. In a matter of one day, the Federal Reserve has undone over half of all of its balance sheet unwinding. Let's take a look at bond spreads. Actually, I need that one. Let's reopen that one. This is U.S. corporate bond spreads, which have risen quickly. Make sure you guys can see that on my screen. Yeah, it's right above my dome. Let's see the HY spreads and the IG spreads here. This is 1.7%, and the HY spreads is at 6%. They've risen very quickly since March 1st, and they're near levels that signaled tradable lows in stocks last year. But it's definitely not time to sound the all clear. Not even close. Let's take a look at gold. Gold has reached $2,000 an ounce for the first time since March of 2022. We are looking at nearly all-time highs. Look at Deutsche Bank asset allocation. The allocation in gold for these guys is absolutely through the roof as well. Money markets, cumulative flows into money markets in the last 12 months has grown exponentially. And since the Fed began to raise rates a year ago, the amount of money in money market funds has increased by around $400 billion. $400 billion. And the increase in inflows last week was more than $100 billion in 1 week alone. That is because the banks absolutely need the Federal Reserve Repurchase Program. The RRP is vital to their ability to stay solvent for whatever short time period they can. The options volume on record last week was 258 million, which is the most we have ever seen in history. And the majority of this, in my non-financial opinion, is because banks have been hedging for the collapse of other banks and other funds. CTA positioning in U.S. equities, projected flows from Goldman Sachs during the next week ranges from 33 billion to 84 billion in the down tape. And this is the index performance here. Basically, you're looking at FANG-MAT stocks, Meta, Amazon, Apple, Microsoft, Google, etc., in comparison to the S&P 500. Why do you guys think that this is changing so greatly? This is moving like this because hedge funds and banks need liquidity and they need collateral, and they will get it mainly in their hedge fund babies, in these FANG-MAT stocks, in order to try to protect themselves from the remaining 495 companies that have not had a change over the last year. They went up and came right back down. Absolutely nuts. Again, large cap versus small cap. Look at the Russell 1000 is outperforming. Russell 1000 consists of companies like AMC and GameStop, even though they're down slightly. Cyclicals, giving back their outperformance extremely fast. Strong versus weak balance sheets. Companies like strong balance sheets. Give me 1 second.
Sure we can manage for 1 minute?
Just had to put my dogs up for a second. Dogs started getting kind of crazy on me. Take a look at the S&P breadth. Today's breadth was exceptionally strong. The global breadth. Basically, there's been a huge attempt to get back to bull markets, and they have failed from immediate overhead resistance. Now a major support line looks to be in the process of getting taken out. And volatility. Take a look at the S&P 500 price action since the 60s. And you can see that equity markets are extremely volatile over the last 6 decades. See, this is back in the 60s, 70s, 80s, 90s, 2000s, and 2010s, now 2022s. Volatility, ladies and gentlemen. The S&P, the SPX S&P 500 is expected to report year-over-year earnings declines of negative 6.1% for the first quarter. And that would be the largest decline since Q2 of 2020 of negative 31.8% when the federal government shut down the world. And it looks like UBS shareholders are about to get fucked. Regulators waived the requirement for a shareholder meeting to vote for or against their buyout of, this complete shit called Credit Suisse and their unrealized losses. Assets under management for Credit Suisse reported outflows of $119 billion in the fourth quarter of last year and $100 billion during the last 3 months of 2022. Look at the volatility in the bond market. TBT is looking extremely sexy right now. Bond market volatility as of March 15th was at around 198 on the log scale. Only time we saw it greater was 2008. See that? In addition to the United States issues, we're seeing that Chinese overnight funding rate soars ahead of the China easing. China has now started cutting rates. Signs of a cash squeeze are appearing in China as the quarter end approaches, underscoring how the nation's economic rebound is driving demand for loans and prompting the central bank to ease policy. I need to crack one open for this. Cheers, ladies and gentlemen. I think you know what this means. The overnight repurchase rate, interbank funding costs indicator, climbed to the highest level since February 2021 on Tuesday. Short-term liquidity is becoming more scarce in the interbank market as lenders set cash aside for quarter-end regulatory checks and disperse more loans amidst a recovery fueled by a reopening in the economy. A reduction in the reserve requirement ratio is likely to ease the funding squeeze, although the People's Bank of China may step in and offer more liquidity support. Where does that sound familiar? When the overnight repo rate soared last month, the Central Bank of China pumped $145 billion US dollars, 1 trillion yuan, into the financial system over 3 sessions. Absolutely ridiculous amount of money printing going on here. And even still, there's a liquidity crisis. Ladies and gentlemen, hyperinflation is upon us. Look at the $119.3 billion in outflows over the Q2. You can't see that. Let me adjust this for you. Q4, I meant to say, not Q2, of 2022. $119 billion in that quarter alone. This is the net new assets and net asset outflows reported by Credit Suisse. At the same time, since the changes at UBS, Moody's rating firm has changed UBS's outlook to negative. So this is not good for UBS whatsoever, when even the rating companies, which are just as crooked as everybody else, can see that you're practically, they're at high risk of being insolvent. Moody's on Tuesday affirmed the ratings group of UBS Group AG and changed the outlooks on its long-term deposit and senior unsecured ratings to negative from stable, following their acquisition of Credit Suisse. Let's take a look at what Janet Yellen has to say, because we've heard her say in the past multiple times that the shadow banking system and over-leveraged hedge funds are one of the greatest threats to the financial system.
Treasury officials reportedly looking for ways to temporarily guarantee all bank deposits and expand FDIC insurance without congressional approval if the banking crisis worsens. The FDIC announced yesterday that it is extending the bid window for Silicon Valley Bank until Friday night. Meanwhile, the White House says Congress should not be let off the hook and needs to take action. Joining me now is Wisconsin Senator Ron Johnson. He's a member of the Senate Finance, Homeland Security, and Government Affairs Committee. Senator, it's great to see you. Welcome back to the program.
Morning, Maria.
So you heard what the White House says. You and your colleagues are not off the hook. You need to act. What do you want to say in the face of all of this worry about the banking sector?
Well, first of all, if you want to put a finger of blame on anybody, blame this administration and members of Congress that have routinely voted for this massive deficit spending. That's what caused the inflation. It's the inflation that caused the interest rate increases. It's the interest rate increases that reduced the value of those bonds and put these banks in jeopardy. So, my problem is Congress has already acted too much in the past, but I am highly concerned about nationalizing all of this risk. When there are no consequences for taking inordinate risks, people will take even greater and greater risks. It'll make the system even less stable. So that's the problem we're in right now. And I'm highly concerned about nationalizing, for example, a national currency. More central control is going to be worse. Obviously, Dodd-Frank didn't work. When the government involves itself in the marketplace, generally it screws things up.
Well, you make a good point, and I know you raised this when you grilled Treasury Secretary Janet Yellen on inflation last week during the Finance Committee hearing. Let's take a look at that. Watch.
Would you agree those are the top three causes of inflation? Deficit spending, high energy costs, and supply dislocations?
I don't believe that deficit spending is one of the main causes
You
of
don't?
inflation.
So she says it's not deficit spending, Senator. Okay, the Democrats borrowed $5 trillion plus in the last 2 years. Yellen is going to speak to the American Bankers Association. The Washington, D.C. summit is happening this morning, and she's saying a lot of the same things.
Well, she's either delusional or she's not being honest with the American public. And I don't think this administration is being honest with the public, but I also know they're denying reality as well. So it's not it doesn't boost your confidence when you have the Treasury Secretary completely denying reality, not understanding exactly what caused this massive inflation. How are we going to get under control? Well, we know how it's coming under control right now. It's really not under control yet, but we're going to ruin the economy. We're going to keep hiking interest rates until you have more layoffs, and you slow the economy down. I mean, this is the classic stagflation, which quite honestly I've been predicting since January 2021 when they started talking about these massive deficit spending bills. When we're coming out of the COVID recession with trillions of dollars sloshing around the economy and all this pent-up demand, the last thing you need to do is add more fuel to the fire by more deficit spending. Yeah.
Well, that's exactly what they did, and now we're all trying to understand why it's taken Joe Biden so long to sign the bill to declassify the intelligence on the origins of COVID-19. He said in a statement yesterday, Senator, this: "My administration will declassify and share as much of that information as possible, consistent with my constitutional authority to protect against the disclosure of information that would harm national security." So, Senator, is this his way of saying, yes, sure, I'll sign the bill, but I'm not going to declassify much?
Yep.
Well, Marie, you know how long I've been doing investigations, how many years I've been trying to pull documents and information out of both administrations. Quite honestly, the deep state does not give up its secrets very, very easily. And so I don't expect any kind of drastic change right now. Hopefully.
When they're talking about the deep state on Fox News, things are really bad. These global powers, the richest people on earth, are fighting for control amongst each other, and the 99% are just pawns.
Hopefully we'll eventually get to the truth, but when it comes to the origin of the coronavirus, my concern is, the WHO was so corrupted and captured by the Chinese government. I think most of the basic pieces of information have already been destroyed, the main piece of evidence. But to me, it seems pretty obvious that this thing originated in Wuhan, and it's very highly likely this leaked from a lab because it was probably was a chimeric virus. It was probably man-made.
Yeah.
Go ahead, Cash Money.
We all know that, Senator, and that's what we're all expecting. But Joe Biden doesn't want to. He doesn't want to confirm it. Why? Is he compromised? You were among the first to, unleash all this information on that Hunter Biden laptop. What's your reaction to what James Comer is finding out now? He says there's 11 more deals after that wire transfer of a $3 million check to Rob Walker, the Biden associate from Communist China. And then the next day they distribute $1 million to Biden family members. It's all in plain sight.
I think Representative Comer and Jordan are doing a great job.
It's all in plain sight, ladies and gentlemen. And after collecting millions from Wall Street, Janet Yellen now decides which banks get the bailouts. She's in charge of the Federal Stability Fund. She's in charge of the United States Treasury. She's in charge of the plunge protection team. Janet Yellen has way too much power. After raking in over $7 million in speaking fees from financial institutions, according to Daily Caller, in the 2 years before being confirmed, Janet Yellen now plays a major role in determining which banks are systemically important. Yellen received more than $7 million in speaking fees from Goldman Sachs, Bank of America, Credit Suisse, Citibank, UBS, Charles Schwab, many more, including Citadel Securities, one of your favorites, everybody, according to Yellen's public financial disclosure report. Though the FDIC insures deposits up to $250K, Yellen told senators the government may insure additional deposits, as it did at the recently failed Silicon Valley Bank, Signature Bank, and if that bank's failure would present a systemic risk to the economy. She says a bank only gets that treatment if a majority of the FDIC board and I, in consultation with the president, determined that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences. SVB, taken over by regulators following a bank run, sold $21.4 billion in debt to Goldman Sachs at a loss, according to Reuters, in a bid to clear negative assets off its books. In exchange, the giant stands to garner a return of over $100 million in fees. Goldman paid $67,500 for a single speech to Janet Yellen, for example. Big banks have paid her speaking fees, and they've been deemed systemically important, benefited from her decision to make SVB and Signature Bank depositors whole. Bank of America paid her $45,000 for one fucking speech and reportedly received $15 billion in new deposits after the bailout. You want to get $15 billion? All you got to do is give Janet Yellen around $45,000. That sounds like a pretty sweet deal, doesn't it? Citi is also experiencing a huge wave of deposits, according to CNN Business. Citi paid Yellen approximately $1 million fucking dollars in speaking fees for 9 speeches, according to her disclosure. The Department of the Treasury did not immediately respond to requests for comment. Fucking hell. At the same time, you've got this clown, Jerome Powell, telling Elizabeth Warren about the 2 million people that have to lose their jobs.
If you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year.
It's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people. If you could speak directly to the 2 million who you're planning to get fired over the next year, what would you say to them?
Inflation is extremely high, and it's hurting the working people of this country badly, all of them, not just 2 million of them. And we are taking the only measures we have to bring inflation down.
And
you're a sacrifice.
Putting 2 million people out of work is just part of the cost, and they just have to bear it.
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%? It's not as black and white as it very
just
very
looking
infrequent.
at the numbers. It actually is pretty black
Alan
and white.
Blinder's written a book on this.
There have been 12 times that we've seen a 1-point increase in the unemployment rate in a year. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exact.
For every 1 percentage point that the unemployment goes up, there's 40,000 people that die in America. And every single time that we have this happen out of the last 12, how many times did we fall into a recession?
Times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right.
Right now, the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control. Even 4.5% unemployment is well better than most of the time for the last 75 years.
I'd like it to be known for everybody listening right now. The only reason that unemployment is at 4.5% is because the Federal Reserve and the Bureau of Labor Statistics have changed unemployment, so that if you've not been actively searching for a job in the last 4 weeks, you're no longer considered unemployed. You're considered out of the workforce. Right now, we have over 120 million people in America out of the workforce. That is the most we've ever had in history. The most we have ever had in history. So you're not considered unemployed if you haven't searched actively for a job in the last 4 weeks. If you looked for a job 5 weeks ago, but for the last month, for whatever reason, you haven't been actively applying, you're not considered unemployed. You're considered out of the workforce. That's the only reason unemployment is at 4.5%. Now, circling back to the interesting analysis of UBS and Credit Suisse, here's Alarian, one of the top economists in the world.
And long term, this is actually potentially a very good deal for them, isn't it?
It is, as long as they can deal with what they've swallowed and they don't get indigestion. And the chairman of UBS made it very clear that what they swallowed was too big, and he intends to shrink it. Now, shrinking is not easy. So that's number one. And number two was the question that was posed at this fascinating press conference last night to the regulators. What are you going to do now when UBS, an already big bank, has become even bigger? What about the monopoly issues? What about the risk of too large to manage, let alone too large to fail? So this is really complex. This was not a perfect solution, but it was the best of the alternatives available.
Alarian is basically saying that UBS is going to be seeing massive, massive losses. And here I have a notepad that I've pulled some of the details that we have here. Let me get back to where I was at. And this meeting is the UBS Credit Suisse conference. It is in German, or I'm sorry, it's in Swiss. So we've done an actual translation here. And you can see Keller Sutter, the Finance Department of Switzerland, translated said, further decisions were necessary, which we have taken today. Specifically, the Federal Council has issued a guarantee for $9 billion to reduce any risks UBS may face. This relates to any potential losses on a very specific portfolio that UBS will assume as part of the transaction. However, this guarantee will only come into effect if any losses incurred by UBS exceed a certain threshold. Ladies and gentlemen, they're talking about a vast amount of derivatives, toxic derivatives, and swaps that contain AMC and GameStop, in my opinion, because that was the Archegos portfolio that blew up on Credit Suisse to the tune of billions and billions of dollars. They've managed to hide it with long-dated swaps, and UBS has to close out these positions. Colin Keller of UBS stated, "I'm well aware of the importance of a solid balance sheet, and UBS will remain rock solid." Said UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture. If they close their short positions and swaps, there is a huge potential for meme stocks that have been heavily shorted via the use of these toxic derivatives and swaps to go to new all-time highs. A journalist asks, who is to blame for this disaster? And Lehman, not Lehman Brothers, but Lehman, he's the CEO of Credit Suisse, said, "We have been caught up in legacy issues," in reference to a Greensill scandal and the Archegos case. In fact, since 2021, with Archegos, we never left the headlines. We were overtaken by legacy situations, by risks that materialized last year. We were affected by a market model that does no longer work in this environment. And many clients have been very loyal for a long, long time. And last autumn, we had this social media storm that has had huge repercussions. more in the retail sector than in the wholesale sector. He's talking about retail investors that have diamond-handed these fucking stocks like AMC and GameStop. And he said, too much becomes too much. And that's when we reach this point. It's accumulation of various facts that's contributed to one another and then materialized at some point, and this then caused the situation. Journalist asked, what positions brought Credit Suisse in this situation? And Colm Kelleher from UBS answered, level 3 assets, long-dated derivatives, and swaps, and so on. We just need time to work this position down and understand them better. They are going to unwind the toxic derivatives, and they will, well, to put it simply, we're going to be filthy fucking rich, in my opinion. Level 3 assets are financial assets and liabilities that are considered to be the most illiquid and hardest to value. Their values can only be estimated using a combination of complex market prices, mathematical models, and subjective assumptions. The term level 3 assets refers to a hierarchy framework that includes assets and liabilities whose values are based on complex mathematical models and internal inputs. Companies are required to value certain assets and liabilities at their current value, not historical cost. And that's exactly what's going on with a lot of companies. They're selling securities and they have not yet purchased them. And they're valuing those at their current value, not at historical cost. The hierarchy framework used to value these assets includes 3 levels, with level 3 requiring mathematical models, as well as expertise of internal subject matter from experts. Plain and simple, hedge funds and family offices holding Credit Suisse as collateral may be in the midst of a margin call, as Deutsche Bank and BNP Paribas and others reduce the value of Credit Suisse securities used as collateral on loans to wealth management clients. BNP Paribas has stopped accepting swap reassignments involving Credit Suisse. On March 15th, BNP Paribas told some clients that it will no longer accept novations where BNP is asked to step in on derivatives contracts on which Credit Suisse is a counterparty, Bloomberg reported on Wednesday. Taking a look at alternative trading system data details for AMC stock, you can see Crossfinder for that's the alternative trading system for Credit Suisse, and UBS rank amongst the top 3 in total trades, total ATS trades, followed by IBKR, Interactive Brokers, as well as you've even got Barclays on the list. A total of 34,500 trades with 4.956 million shares in one day. This was the week of 9/5. So that was in 1 week there, in a 1 week period, So those are the alternative trading system details for AMC. So it's quite obvious, and it's not conjecture, but this is facts, figures, and proof that UBS, INCR Intelligent Cross and Crossfinder, which is for Credit Suisse, and IBKR are trading a ridiculous number of AMC stock in their dark pools. And they do this in order to manipulate the price. FINRA has come out and actually had to bail out Credit Suisse in these situations. And their alternative trading system, dark pools, they exempt transactions with non-member entities like Credit Suisse over their derivative products, and their swaps allow Archegos to obtain synthetic leveraged exposure to the underlying stocks without actually owning them in order to hide transparency. I pulled this up on Twitter when FINRA came out and so proudly stated this to everybody. They adopted amendments to Rule 6732 to extend the current alternative trading system, dark pool, trade reporting exemptions to transactions that involve at least one FINRA member other than the ATS, so long as the other conditions are met. The Department of Justice is using swaps to avoid 5% ownership and well-timed purchases to contribute to significant artificial increases and changes in the prices of securities. Conversely, they are selling stocks which cause prices to deteriorate. FINRA, in my opinion, is allowing them to hide the supply and demand through these swaps. And it is all directly related to Credit Suisse, Archegos, Bill Hwang, and all the other companies, market makers, short hedge funds, family offices that have shorted meme stocks like AMC and GameStop. Archegos did not report those publicly. Archegos swaps trades typically caused its counterparties to acquire a share of stock for each one swapped with Archegos in order to hedge against market risk on the position. Thus, Archegos swap positions grew, and so did the counterparty's purchases of the corresponding stock. More than 5% of the publicly trading shares of the issuer's stock. Those counterparties therefore were required to and did file public disclosures. But because of these changes, now Credit Suisse has not had to file those same disclosures. Now we're seeing Deutsche Bank, Societe Generale, BNP placing restrictions on their trades involving Credit Suisse and these other securities. Can't play the song, even though it's a great song, because I'll get a copyright strike. My apologies. Another global bank has reduced its unsecured exposure to Credit Suisse, which includes all lending with no collateral, according to people associated with knowledge of the matter. This likely explains why counterparty risk and credit default swaps at Credit Suisse have barely moved down after the takeover and the $50 billion liquidity injection into SNB. And the Swiss National Bank is now offering that 100 billion franc liquidity assistance, which is about $100 billion, to UBS, while the government is granting a basically 9.25 billion US dollar guarantee for potential losses from assets UBS is taking over. It is quite fucking clear what's going on here to me, ladies and gentlemen. It is quite fucking clear. And that is the fact that Credit Suisse is fucked, UBS is probably fucked, everyone linked to them and their swaps and ridiculously over-leveraged short positions on meme stocks are going to get fucked. And Jerome Powell and Janet Yellen are going to get the motherfucking money printer out to bail them out. As long as I get paid. You're damn right, my brother. We're going to be so fucking rich at their expense because of their shitty, over-leveraged bets. And Credit Suisse has been fined hundreds of millions of dollars, if not billions of dollars, every single year. Almost here. Credit Suisse has been fined over 50 times for a total of $11.4 billion since 2000, an average of $570 million a year, because they misreport their fucking swaps. Credit Suisse failed to, according to my friend Edward Britchick here on Twitter, Credit Suisse failed to report their short sales for over 7 years, from February 2015 through April of 2022. This is absolute fraud, and he is absolutely right. From February 2015 through 2022, the Credit Suisse securities documentation shows that the firm failed to establish and maintain a supervisory system reasonably designed to comply with FINRA rules regarding trade reporting of short sales in violation of FINRA rules. Sometimes I just get sick of being right. And you know what? As much as a lot of people hate the orange man, the guy tried to warn people. I have never voted for Donald Trump. I've never voted for a Republican president. But the guy brings up some great fucking points.
Look, we have the worst revival of an economy since the Great Depression. And believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful. And we have a Fed that's doing political things. This Janet Yellen of the Fed. The Fed is doing political by keeping the interest rates at this level. And believe me, the day Obama goes off and he leaves and he goes out to the golf course for the rest of his life to play golf, when they raise interest rates, you're going to see some very bad things happen because the Fed is not doing their job. The Fed is being more political than Secretary Clinton. Look.
And he was not lying. Donald Trump was telling the truth way before anybody else was willing to admit it. Credit default swaps for Credit Suisse have not come down since the bailout of SVB. They have not come down since their buyout from UBS. And the fact of the matter is,
if you continue raising interest rates as you plan, unemployment will be...
Did not mean to have that one pop up right there. UBS's acquisition of Credit Suisse is not good for either of them, but it was their only solution. And at the end of the day, people have been warning about this for years. Many people like them, love them, hate them, doesn't matter. The fact of the matter is that Credit Suisse has been lying and not properly reporting their short sales for decades. Decades. Archegos blew up in their face because of their swaps and hiding of their positions, and they were enabled to do so by Credit Suisse and other market makers with which they trade. Other short hedge funds and family offices will also have to close out their positions. And currently we have AMC about to face a lawsuit, and a judge is, in my opinion, highly likely to throw out the lawsuit on April 27th, if not prior to, because retail investors greatly, by vast margin, around 88 to 89%, voted to allow a reverse split, a conversion, and dilution of AMC stock. So a conversion of APE shares, the AMC preferred equity shares, to be converted into AMC common stock, and they will receive a new name. They will have a name change and a new CUSIP number. So when you change a CUSIP number alone, that does not require shorts to close out their positions. If you change a name alone, that does not require shorts to close out their positions. But if you do a name change and a CUSIP number change and convert APE into AMC stock and then reverse split and then dilute by having the company sell shares on the market, that is much more likely to force shorts to close their positions, because the changing of a CUSIP number and a name would require massive changes. Let's put it that way. I can't explain it without spending another hour on this video. So
it would mean the synthetics fuck themselves in the ass.
It would mean the synthetics fuck themselves in the ass. That's right, because a lot of positions would have to be closed, a lot of shares would have to be purchased back, and every time AMC stock sells shares on the market, like they did in January of 2021 and in May and June of 2021, the stock price shoots up. Again, I'm not a financial advisor. This is not financial advice, but at the end of the day, I still think we're going to be filthy fucking rich. And I wouldn't have hundreds of thousands of dollars invested in these stocks if I didn't feel that way. So I would just like to say thank you to everybody for your support. Thank you for listening. Thank you to Eagle Eye Productions, Riptide Redemptions, Grandpa Barney, all my friends here in the think tank for your constant support. And I'm very much looking forward to the day that this happens, because MOAS is imminent. We're going to be so motherfucking rich. Damn. Now, with that, I bid you adieu. Have a great day, everybody. Time for a song. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff.
Peace out, everybody.
Okay, 3, 2, 1, let's go.
Somebody get that money printer out. Who's got that money printer? Let me hear it.
I want my fucking money.
Jerome Powell, get the fucking money printer out.
Griffin,
I want my fucking money. Young motherfucker. Brr! Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Listen, I want my fucking money.
You're an original,
Hey,
aren't you?
Yellen, cowboy, give me the fucking money. Get the goddamn money printer out.
Great. Bounty cutter.
We're gonna be so fucking rich. Get the goddamn money printer out.